Alright, I don't need to introduce myself again. The paper I'm presenting is Value versus Growth, Australian Evidence. My co-authors, Sebastian Strakowski and Marty Viraragaran. And I will say this is the first time ever that I've been recorded. So usually I take all the glory for anything that happens in the paper. And then if anything goes bad, I just blame it on my co-authors. But I can't do it this time because I've got a camera sitting over there. So, I will say hi to my boss. Hi Marty, because he'll be watching this once it gets uploaded online. So, in this audience, I'm not going to talk too much about, what is value glamour. I mean, like George gave us a little bit of a brief introduction to that. Value stocks with high fund. I'm going to go in a different route. I realise that practitioners like to talk about price to book, price to earnings, but we as academics, we talk about book to market, earnings to price, just because we don't like to divide by zero. So, value versus glamour, high fundamentals to stock price. What is the proxy that we commonly use these days? We use book to market. Almost everyone invariably these days uses book to market. One, I think in a large part it's been impacted by Farmer and French, the Farmer and French three-factor model. Book to market is our measure of value versus growth. But let's have a think about why we did that, and that's what I'm trying to do in this paper. Because there are other proxies for value glamour out there, such as earnings to price, cash flow to price, and sales to price. So they're all constructed in a similar fashion. The accounting fundamental, book value, earnings, cash flow, or sales divided by price. So why are we all using book to market? Why are we ignoring these other measures? And I think there are some good reasons for that, and that comes out in this paper a little bit because we're looking at all of these measures in combination. So what are some of these issues with these alternate measures of value glamour, earnings to price, cash flow to price, and sales to price? Well, earnings and cash flows can be negative. So what can we do? I mean, like most people will just chuck out all of the firms with negative earnings and negative cash flows and ignore them. Some other people haven't, but I'll come back to how they dealt with that in just a second. Sales can be zero. I mean, like in my sample, and I was very, very surprised by this when I first saw it, 43% of my sample has negative earnings. 45% of my sample has negative cash flows. Admittedly, they are the much smaller stocks. But it's still a very significant proportion of the sample. 25% of my sample has zero sales. Firms starting out, no trading revenue. What do we do in these cases? But book value can also be negative, but there's a much smaller proportion of stocks which have negative book value. In my sample, about 5% have negative book values. And again, we usually just throw them out of our analysis and not worry about them. But with book to market, that's not so much of a problem because it's only 5% of the sample. With the others, and I think this is one of the reasons why people focus on book to market more, because there's a much higher proportion of negative earnings, negative cash flows, and zero sales for those other three measures. So, what are my research questions? Well, is there a value glamour effect in Australia? We already know the answer to that. Yes, there is, based on book to market only. I mean, like I've written about 15 asset pricing papers now in Australia. I either use the Farmer French model or I do some Farmer Macbeth regressions. So book to market or HML is always there. It's very strong. Some independent researchers looked at it as well. Richard, I believe you have, and I mean, like, we do find it in Australia. So, but more so this paper is focused on which is the superior proxy for value glamour. I'm going to look at all four of those proxies that I mentioned: book to market, earnings to price, cash flow to price, and sales to price, and decide which is the best one we should use. And talk about some of the issues for and against them. But I'm not the first person to do this. I mean, like a number of people have looked at, different variables and returns, and in their analysis looked at, very different measures of value glamour. So Chan et al., book to market, earnings to price, cash flow to price, 3 of them, and size. That was in Japan. Lakonishok et al., again the same 3, but they used past sales growth. Barbie et al., they were the first to use sales to price. The other guys used past sales growth and sales rank. They controlled for leverage and size. Similar sort of stuff. They've all got 1, 2, or 3 value glamour proxies in each, and maybe size and leverage as well as additional control variables. So what did they find? Well, there was a bit of a mixture in the results. Chan's results favour book to market, cash flow to price. You can see them there, I've highlighted them. Lakonishok earnings and cash flow, Barbie sales, Kai book to market. So there's a bit of a mixture as to what's being favoured. But we all focus on book to market. Why do we do that? So, moving on to my data. Standard, Australian sources of data. The test period is 93 to 2004. I've got a relatively healthy sample of 137,000 firm-month observations. The one point I will make is the reason I started in 1993 is that in Australia, firms are only obliged to prepare cash flow statements from 1992. So, but I couldn't go back too much further anyway, because our accounting data really only starts in about the late 1980s, early 1990s. So I could have only gone back a few more years anyway. But I had to start in 93 because I required firms to have cash flow data. All right, we've seen everything we need to see in the portfolio returns analysis. The regressions are not, at least the single variable regressions are not going to tell us a lot more. Here are the results. Book to market, positive premium. Sales to price, positive premium. Leverage, positive premium. Size, insignificant. That's not unusual because of the non-linearity present there. Earnings to price, we needed to split them to model this and to analyse it. We needed to split them into two interaction terms because we're not expecting the same. We're not expecting positive relationship all the way through or a negative relationship all the way through. So we needed to split the variables. So this variable has positive earnings to price and zeros for all the negative earnings firms, and this variable has zeros for all the positive earnings to price and negative earnings to price. So it's an interaction term which allows us to capture the non-linear relationship between earnings to price and returns that we expect based on our intuition. And again, we see with these regressions exactly what we expect. Positive relationship for positive earnings to price, negative relationship for negative earnings to price. Same thing holds for cash flow. Positive relationship for positive cash flow to price, negative relationship for negative cash flow to price. But how do we answer the question of which is, well, actually, and then we did that again, we just said, well, let's just look at firms that have positive earnings. We see the same positive relationship. Let's look at firms that have negative earnings. We see the same negative relationship. So it's, if we just split them into positive and negative, we see the same thing. But how do we decide which is the best variable? Well, we need to do a multiple variable regression. So that's the final thing that we do. First off, we put all four of our value glamour proxies in there, and then we do an additional regression where we control for leverage and size. And what do we see? Well, some of them are still significant. Book to market and sales to price are significant. The positive EP and CP terms are significant, but the negative ones are no longer significant. So something's gone on stupid with my minuses there. So the negative ones are no longer significant. And that holds true for both when we include the control variables in there as well. So from this, we can say, well, look, we don't think that earnings to price and cash flow to price are the best variables because the negative interaction terms are not significant. So we're thinking it's either book to market or sales to price, which is a superior proxy. Another thing which I don't think people do is they don't look at, the positive earnings and negative earnings separately. So people don't look at, the positive earnings and the negative earnings, samples separately and see what goes on in there. We said, let's look at them separately and see what's going on, particularly since we're stressing this argument of positive and negative earnings. Well, we do see a lot of differences here. Now, both book to market and sales to price, they are insignificant in the positive earnings sample. And the interaction terms remain pretty much significant. When we look at the negative earnings to price category, you just book to market. I'm trying to behave. Book to market remains positively significant. Sales to price becomes insignificant. The interaction terms are insignificant. We were a little bit worried about these because we saw these in the full sample and in the full sample and in the subsample, and we did a lot of multicollinearity testing, a lot of other regressions to make sure that nothing funny was going on, and we're pretty confident that one of these variables is knocking these ones out. So on balance, we're sort of favouring book to market because it's the only one which is significant for the negative earnings group, and both book to market and sales to price are significant for the positive earnings group. And I'd better finish up. So, look, we know there's a strong value glamour effect pretty much everywhere. We already knew there's one in Australia, we've just shown that. We also showed that all 4 of our proxies are individually significant. They all capture the value glamour effect in isolation. On balance, we're concluding that book to market is a superior proxy. Look, you know, it's not the strongest argument based on the regression results. They're not extremely neat, but I think they tend to favour book to market. But like, even though we showed how we can incorporate negative earnings and negative cash flow firms into an analysis, you know, you can do it, and you can incorporate firms with negative sales into an analysis. It's still easier not to. It's still easier just to work with book to market, which is positive for 95% of the sample. Throw out the 5% of the firms that have negative book to market and just use that as your value glamour proxy. So in that respect, it does support the Farmer-French model who used book to market to construct their HRL factor. But we do see some nuances based on whether earnings are positive or negative. And I think we've showed how we can analyse negative EP and CP when we expect that different relationship. And you know, I think we're the first to show this. We show findings which are consistent with the value glamour effect in negative earnings firms. That's my presentation.